Greetings and thank you for joining us for another webinar in which we talk about the economic impact of this current pandemic, the coronavirus pandemic. One of the things that we've noted, pardon me while I get my control panel out of the way, there we go. So one of the things that we're all doing, obviously, is paying attention to a lot of new information that's flowing in several different realms. First and most importantly is the information rolling in from the health authorities and the epidemiologists, telling us what's happening around the country and around the world with respect to new cases, with respect to bending the curve, and with respect to progress made in terms of figuring out what we're going to do about this pandemic with respect to how we behave, the kind of medical interventions that may become available. And then there's another realm, which is the realm of government action. It's the realm of big macro pieces that are happening, not just in the United States, but everywhere in the world, in which we collectively, through our governments, try and minimize the impact, try and keep the economy alive so that when we finally get past the pandemic, when we get our arms around the medical aspects of this, we'll actually have a robust economy that can spring back into life. Because that's such a large part of the story right now, we thought we'd do another webinar that would focus on those economic impacts, and most especially the actions on the part of the U.S. government. So you can see we're going to talk about we're going to do a little bit of an update on the economic impact of the pandemic. We're going to talk about the fiscal responses, which are those responses that come from Congress and the White House. We're going to talk about monetary responses, which are those that come from the Federal Reserve. We're going to talk a little bit about inflation, because this is also something that's on everyone's minds as a consequence of the massive interventions that are taking place, especially on the monetary front. And finally, we'll talk a little bit about what comes next, and hopefully we'll have a Q&A at the end. I hope you all have comments you wish to share. I will share your comments with the audience, or questions you wish to ask. I'll do my best to answer them. So let's move on. I want to start with something that we've talked about before. You all received an email from us week before last, talking about this thing called or I should say last week, talking about this thing that Jim Collins, who was the author of From Good to Great and Built to Last, referred to as the Stockdale Paradox. Now, I've talked to a number of you who didn't get a chance to look at the brief video clip that was included with that email, so I'm going to take just a minute to tell the story. As Jim Collins tells the story, he was teaching at Stanford at a time when Admiral Jim Stockdale, was at the Hoover Institution, studying philosophy, I think. Admiral Jim Stockdale was notable for being the highest ranking officer to have been detained at the Hanoi Hilton in North Vietnam. He'd been shot down during the war, and he was detained there for many, many years. And he was at their mercy. They could take him out and torture him anytime they wanted. He was tortured 20 different times. And he co-wrote a book with his wife in which they wrote alternating chapters about their respective experience during those years. And Jim Collins went and read the book in preparation for the conversation he was hoping to have with Admiral Stockdale. And interestingly, he found the book, as he put it, depressing, even though he knew the ending. I mean, in a sense, there was a happy ending in that Admiral Stockdale was released, came back to the United States, and yet Jim found it very, very depressing. So when he finally had the chance to talk to Stockdale, he asked him what the experience was like. And he said it must have been terrible. It must have been almost impossible to maintain hope. And Admiral Stockdale said, "No, not at all. I always had absolute faith that not only would I survive this, not only would I come through this, but I would make it into the defining experience of my life." And apparently Jim Stockdale and Jim Collins continued to walk, and Collins then said to him, or then asked him, "So who didn't come out of this as strong as you did?" And Stockdale said, the optimists. And Collins was taken aback. He said, you sounded pretty optimistic to me a minute ago. He said, and apparently Stockdale said, I'm not an optimist. He said, well, Collins asked, so how would you describe the optimists? And Stockdale said, the optimists were the ones who were convinced we'd be out by Christmas. And then we weren't. And they were convinced we'd be out by Easter. And then we weren't. And he said, and they died of a broken heart. He said, you have to combine an absolute utter faith that you will prevail, that you will make it to the other side, with the ability and the discipline to look at the brutal facts of the moment. And that's really something that we think is important, is to have an unwavering faith in ourselves and in humanity writ large, that we will get through this. Human beings are resilient and they are ingenious, and we will get through this. But we also have to be prepared to confront the brutal facts of the moment. And this is, you could think of it as grounded and hopeful, grounded hope. And it's very much that one of the reasons this appealed so deeply to me and to the rest of the Yeski Buoy team is that this is perfectly consistent with our fundamental worldview. We have a fundamental worldview that starts with a belief that human beings are resilient and ingenious and growth oriented, and that they will overcome problems. And so that's clearly a very optimistic beginning, and we always run the risk that we're going to be painted as excessively optimistic, as if we're blindly optimistic. But in fact, we believe we do a good job of looking the facts in the face, of being aware of the brutal facts of the moment and dealing with those, while never losing our faith in the that ultimately we will prevail, we will get to the other side. You could think of it as grounded hope, or you could think of it as realistic optimism. But anyway, I just wanted to lay that out as a foundation for everything that follows, because some of the things I'm going to share look bad, some of the things maybe don't look so bad, but it's all part of looking the brutal facts in the face, while at the same time maintaining utter faith we'll get to the other side. So here's the ongoing impact on unemployment. And I shared some of these numbers through March 28th, the last time we met. And as you can see, they continue to be unprecedented. In fact, these weekly numbers are, these are new. Each of these numbers represents new claims for unemployment insurance each week. Absolutely unprecedented. And if there's anything, if there's anything positive we could take away from this, is that as unprecedented as these weekly numbers are, the rate at which they're increasing, the rate at which the rate of growth is decreasing. It's still stupendous. It's still off the charts, but the rate is decreasing gradually, as you can see. It seems to have peaked on March 28th, and it's slowly, the rate of new claims is slowly declining since then, and we can only hope that continues and accelerates. But this is not to change the fact that this is a brutal fact. This is 26 million of your fellow Americans are not employed right now, and that's obviously having a huge impact on the economy, not to mention a huge impact on their lives. So it's official now. The first quarter, during the first quarter, the U.S. economy shrank by almost 5%. This is the first time in a long time we've had a decline, and it's just about an unprecedented decline for any given quarter. This is made up. Obviously, the economy is made up of many different sectors, and as you won't be surprised. As you won't be surprised to hear, it's consumer spending and travel were among the biggest components. There were a few components that actually had positive growth. There was positive growth in trade, for example, but the consumer sector took a massive hit, and the net of all of the different sectors is a decline of almost 5%. I think we can basically assume we're in a recession now. It's almost assuredly we'll have further contraction this quarter, the second quarter. And so we can assume we are in a recession. This drop, as you can see, I noted here, is the greatest, it's the biggest drop we've seen since 2008 in the Great Recession. This chart will look familiar. I showed a version of this 2 weeks ago at our last webinar. And the trend has, the positive trend since March 23rd has continued. You can see how starting on February 9th, the markets just fell off a cliff. That was when sentiment shifted. That was when suddenly investors collectively in the US and all around the world had one of those rapid about faces where sentiment shifted and they believed that this crisis was going to be massively worse than had been previously believed. And the markets, as a consequence, fell off that cliff. But starting on March 23rd, and just to show you how rapidly markets can change, it started coming back. And markets have retraced half of what they lost back in February and March. So a couple of things. This is an example, again, of how discontinuous market moves can be. This is an example of why you really can't time the market because it'll fall off a cliff, and by the time you blink and realize what's happening, it's too late. And if you then choose to act and get out, well, you'll miss the rapid rise, and by the time you realize things are bouncing back, it's too late. So this is not actually an unusual pattern. It's unusual in its magnitude. Fortunately, these moves of this magnitude do not happen very often, but it's not unusual in terms of the pattern. The pattern is quite interesting. So if you looked at your, I actually talked to someone yesterday who said, I looked at my portfolio on January 1, and then I really was afraid to look at it since, but I looked at it yesterday. He said it didn't look as bad as I expected. Well, that's because he didn't look at it on March 23rd, on the 23rd of March. And this is maybe one of the virtues of not looking at your portfolio every day. So now let's move on to governmental responses, starting with the fiscal responses from Congress. And the one thing I'm going to say, I'm sure I've said this before, and I'm sure I'll say it again. I actually think that this is one of those times when we can be very proud of the organs of government. We can be very proud of our government. The Federal Reserve responded to this crisis much more rapidly than it responded to the Great Recession. And not only more rapidly, but in much greater magnitude. The Fed showed up early, and it showed up big in a way that we didn't even see during the Great Recession. Tremendously impressive, and we'll talk more about that in a minute. And Congress, notwithstanding what, we're used to a very divided Congress, we're used to a very polarized political landscape right now. But as you'll see, Congress came together, Republicans and Democrats came together, and they came together in a sort of a cascading fashion. The responses got bigger and bigger and bigger as they realized the magnitude of the problem. But they nonetheless, they came together, with continuous responses, and I don't think they're done by a long shot. And I'd like to, before I move on to the specifics, I'd like to emphasize, as I did in our last webinar, even though you often will see this in the newspaper referred to as fiscal stimulus, it's really probably not the right way to think about it. Fiscal stimulus is most often about trying to stimulate economic growth. This is really more like fiscal support. All of these moves have really been intended not so much to spur growth, but to keep the different sectors of the economy alive, to keep the pipes open, so that when we do get our arms around the medical aspects of this pandemic, there will be an economy left to recover. And so we'll talk about some of the details. But again, I think more needs to be done. But thus far, I'm very proud. I'm very proud of all of our leaders in Congress, in the House, in the Senate, in the White House. This has been, at least in terms of the fiscal response, this has truly been appropriate, and I hope will continue to be appropriate to the magnitude of the problem. So first, on March 4th, we had the Coronavirus Preparedness and Response Supplemental Appropriations Act, and that was $8.3 billion. And normally, an emergency appropriation of nearly $10 billion would be considered a big deal. But as we can see, Congress rapidly realized that they needed to do much more. And so a mere 2 weeks later, they passed the Families First Coronavirus Response Act. And that was exponentially larger at almost $200 billion. Then on March 27, only 9 days later, they passed the CARES Act, $2 trillion. And we'll talk a little bit about that, but we've spent time on that in the last webinar. We won't spend too much time on that today. But the CARES Act, the biggest piece of legislation ever passed by Congress. And again, they decided to show up big in response to the magnitude of the problem. On Friday, a new act was signed into law, the Paycheck Protection Program and Healthcare Enhancement Act, which provided almost another $500 billion of funding. And we'll delve into what that consisted of in a moment. And then, will there be a round 5? Honestly, I think there almost inevitably will be, because clearly Congress and the White House are committed to keeping the economy alive, so that again, I keep saying, keeping the pipes open, but keeping the economy alive so that so that businesses that would otherwise be viable absent this pandemic will be able to survive the economic impact and be able to bounce back to life when we get to the far side. So the CARES Act. So this was a really impressive array of benefits aimed at both individuals, small businesses, governments, healthcare workers. One of the key elements for individuals was the $300 billion in cash payments, which was essentially $1,200 for each adult and $500 for each child. I'm sure that doesn't sound like a lot of money, but it was at least a start, and we'll see if there are additional cash transfers as well. There was also a massive extension of additional unemployment benefits that rolled out to the states, and I will be talking about that in more detail as well, in terms of how that has manifested itself at the state level. The small business lending, one of the most notable elements of that was the PPP, the Paycheck Protection Program, which, as I'm sure you all know, ran out of funding almost immediately. It seemed like within days or a week, the funding was gone. It had been claimed by those who were applying for coverage. And notoriously, again, if you're reading the headlines, notoriously there were quite a few large public companies and organizations that claimed PPP loans. I think AutoZone managed to claim $77 million from the PPP program. The Lakers got money, and a number of others. And a number of those organizations have, having been shamed in the last week or so, have started giving the money back. So a little bit of that I'm going to say misappropriated funding has gone back into the program, but it did run out of money, and that's what the most recent act in part was meant to remedy. So I'm calling this CARES 3.5 because I heard Chuck Schumer and others in the Senate referring to it as 3.5. With the idea that I think there's going to be a CARES 4.0, and we'll talk about a little bit about that. But this was the Paycheck Protection Program and Healthcare Enhancement Act that was signed into law just this last Friday. And it added another $321 billion to the Paycheck Protection Program. It provided an additional $60 billion of emergency lending to small businesses. There was $2 billion in administrative expenses provided. One of the things that goes along with this is trying to actually administer the doling out of the money and tracking it. I mean, so $2 billion may sound like a lot for administrative expenses, but this is a pretty massive administrative apparatus that has to be mobilized. Hospitals got another $75 billion, and another $25 billion was provided for enhanced testing. And this is something that, again, is in the news every day, that governors and mayors and the White House are all saying that one of the things that's going to have to happen before we can start to loosen the lockdown is that we're going to have massively increased testing. And so this is probably only the first of several rounds of funding for enhanced testing, or enhanced and expanded testing. And then there's been a lot of the Brookings Institution and the Hoover Institution and a lot of think tanks have been talking about, well, what comes next? Probably more funding for automatic stabilizers. Automatic stabilizers are those elements of the macroeconomy, normally governmental programs, that kick in and sort of automatically provide additional spending and support at a time when the economy is shrinking. That's why they're called stabilizers. A very common form is taxes. Oftentimes taxes are reduced or deferred during a downturn. And we saw this time. Tax filing deadlines were deferred. Payroll tax deadlines were deferred into next year. Property tax deadlines were deferred. So that was a form of support, and we'll see how much more of that happens. We had enhanced unemployment benefits, and I'll talk about that in more detail momentarily, but that's a big form of stabilizer. And we saw a lot of that during the Great Recession, where unemployment benefits kept being extended. Normally when they were about to run out, they would extend them further because the economy was still not recovering quickly enough to create the jobs that were needed. And so we'll see, continued funding for the Payroll Protection Program. If this is one way that people can be kept on the payroll and companies can be kept viable and their staff can be kept viable. This is the thing about keeping people on the payroll, is that not only does it mean that they have a paycheck and they're able to feed their families and take care of their families, but it also means that they're standing by and ready, willing, and able to go back to work when that business can open up again. There's also been a lot of talk about expanding lending to other expenses, other categories of expense. The Payroll Protection Program, for example, which is primarily intended to keep employees on the payroll when a company otherwise is either shut down or operating at a reduced level. Some of that, I think it was up to 25% of that, could be used for rent and other expenses. So those are also pretty critical, and there's a lot of talk about expanding lending in that area as well. So in terms of other programs, this is a program, this is probably happening in many states. I'm most aware of the program that just was rolled out in California, the Pandemic Unemployment Assistance Program, which was partially funded from CARES. And what it does, uniquely and for the first time, is it provides unemployment benefits to the self-employed, independent contractors, gig workers. These people historically have not qualified for unemployment benefits, and now they do. And so if any of you listening to this webinar are self-employed and have been impacted negatively by this pandemic, you live in California, you need to apply to this program. One of our friends and clients was applying day before yesterday, which was the first day the website was open. And honestly, the website was crashing all day long. But we kept talking about it, and she kept going back again and again. And finally, I got an email, I think it was about 8 o'clock at night. She said, it went through. So, it's brand new. There's a huge demand. Don't be disappointed. But if you qualify, if you are self-employed, if you're an independent contractor, a gig worker, and you've been negatively impacted, this program will now provide you with unemployment benefits, which you would not previously have qualified for. The basic program runs for 39 weeks, and there's a 13-week extension that was funded by the CARES Act. It was, it's funded from the additional federal funds that came through. So that's just again another example of support that's partially federal, partially state, and that's offering benefits in a way that is utterly new. So I want to move on now to talking about the Federal Reserve. And as I said earlier, Jay Powell I didn't think I could be more impressed by a Federal Reserve chair after watching Ben Bernanke in action during the Great Recession. He was just extraordinary and heroic, in my opinion. I think Jay Powell is showing up pretty heroic as well. As I said earlier, the Fed in this current crisis, the Fed showed up sooner and bigger than it ever has ever. And this is Jay Powell showing extraordinary leadership. As you can see, he said, none of us has the luxury of choosing our challenges. Fate and history provide them for us. Our job is to meet the tests we are presented. And indeed, that they have been doing so. So let's talk about some of the things they've done. One of the first things they did is they moved the federal funds rate to zero, basically zero. I think it's technically a range from 0 to 0.25%, but it's basically zero. And the Fed funds rate essentially sets the tone for all short-term interest rates. So those of you who are beginning to enjoy the fact that your money market fund yields have gotten up to 1.6, 1.7%, sadly, they're back down to a fraction of a percent, to a tenth of a percent, or maybe 0.2%. And it's as a consequence of this move on the part of the Fed. So if you depend on interest rates for your savings, I'm sorry, This is an unfortunate reality, but this is a very powerful force for keeping liquidity in the economy, helping keep the economy alive. Also, a return to massive quantitative easing, which is basically bond buying. And the Fed was back in the Great Recession, or in the period following the Great Recession. The Fed engaged in quantitative easing, mostly to ensure that longer-term interest rates stayed low. The Federal Reserve directly controls short-term interest rates, primarily through the Fed funds rate, which it sets directly. But longer-term interest rates are set in the bond market by bond investors. Longer-term interest rates are set by bond investors buying and selling. If bond investors are aggressively buying bonds, they drive up the price, which drives down the yield and drives down long-term interest rates. If bond buyers are pessimistic, and there tends to be a lot of and bond prices fall, that tends to drive up interest rates. Well, it's one thing to say the Fed only directly controls short-term interest rates, but if the Fed decides to be a bond buyer, then it can have a pretty big impact on long-term interest rates also. And during the Great Recession, the Fed wanted longer-term interest rates to also stay low, so it became the biggest bond buyer in the market. It was the, whatever you want to call it, it was the big boy. It was the bear in the room. It was buying massive quantities of bonds, mostly treasuries, but also mortgage-backed securities and others. And as a consequence, longer-term interest rates stayed very low. This time, the quantitative easing is more driven by a desire to get reserves into the banking system. And I'm going to talk about that mechanism in a minute as well. They started new lending programs, and this is very unusual. They started a Main Street lending program, which is intended to backstop small and mid-sized businesses by providing lending to them directly, or I shouldn't say that, to provide lending in conjunction with the Treasury. This is actually a program where the Treasury was given over $400 billion by Congress to lend out to small and mid-sized businesses. What the Fed has come along and done and said is to say, we will match that. We will lend 10 times the amount that the Treasury has to lend out. And the Treasury's on the hook for the initial losses, so that there's still going to be some discipline there. But the Fed came along and said, we are going to massively leverage that program. And this is going to be challenging, honestly, from a historical perspective. The Federal Reserve is very good at lending at lending to financial institutions, lending to banks and brokerage firms. The Fed knows how to lend to financial institutions. And of course, one of the criticisms of how the Fed handled the Great Recession was that it bailed out the banks, but it didn't bail out Main Street, and you had a lot of pain among non-financial businesses. So this is going to be a challenge. As I said, the Fed knows how to lend to financial institutions. It'll be interesting to see how well it does in lending to other institutions. Hopefully this will work out well. One thing that's worth mentioning, just as a historical note, the U.S. taxpayer actually made money on all of that lending that took place during the Great Recession. All of the bailouts that the federal government did out of, part of the, there was an $850 billion bailout package. There was a bailout of the automobile companies. The Fed did massive lending to bail out the banks. We, the taxpayer, actually made money on all those investments. So anyway, little footnote. No one's aiming to make money this time. And in fact, I read one commentator who was saying, if the Fed doesn't lose money on this program, it will not have been aggressive enough. I mean, and this is the tricky balancing act. I was talking to a reporter yesterday about this balancing act of wanting to keep alive businesses that, but for the pandemic, would have been viable, while maybe not keeping alive the businesses that were meant to go out of business. We're in a situation now where you have to move fast and you have to move big, and it's really not possible to distinguish. So probably there are a number of companies that quite rightly would have gone out of business just in the natural course of things that will be propped up longer than would otherwise be the case. And if that's the price we pay to keep alive those businesses that otherwise would have been viable, I think we just have to swallow that. The Fed also was providing financing for state and local governments, and they'll basically lend for up to 3 years. And this is really important. I'll mention this in the next slide, but I'll just get to it now. You know, I often talk about the fact that the federal government should not be thought of as being like a household. It's not. And I'll touch on that in a minute. But state and local governments, they are like households. They cannot run deficits. They have to cover their spending. And so when revenue is down and it's difficult to issue bonds and all the rest, you know, but I mean, obviously every state in the union and every city in this country is going to be suffering from a massive decline in tax revenue. And it's a difficult time to borrow. Sorry, I have a little bit of a cough, so not a coronavirus cough. So this is a case where states and municipalities are in desperate need, because this is the last point in time when you'd want to say, well, states, you just need to cut back on your spending. What are they going to do? Are they going to start firing firefighters and police? Are they going to start shutting down hospitals? This is the time when they need to not only keep spending, but probably spend more on emergency services and medical responses. So this is a really good move on the part of the Fed to provide an additional backstop for the states. I actually think even though the Senate Republican leader, Mitch McConnell, has spoken against Congress providing any kind of financial support to the states, I actually think some support will probably come from that quarter before we're done. And finally, they're also providing financing for what are sometimes called fallen angels, companies that as a consequence of this pandemic and the economic shock that goes along with it, have seen that the quality of their bonds fall from creditworthy into junk. And so the Fed is stepping in to support those companies and providing financing for them and for these collateralized loan obligations, which are pools of loans. So again, this is the private sector. This is the Fed trying to maintain order in the corporate bond market. I have a question here or a comment. What is missing from the federal government is an estimate of funds required. How much money will small businesses, food banks, unemployment, and state workers need to prevent fire department, police, and teacher layoffs due to the loss of revenue? What assumptions are those estimates based on? No second wave of infections? Well, assumptions have been in motion. If you look back to the, if you think about the earlier slide in which I was showing the 4 rounds of response from the federal government so far, as you can see, it went from 8 billion to 192 billion to 2 trillion to another $500 billion. And I think what's happening is that the Fed and Congress are they're operating in real time. They don't know. I mean, they have projections, but I think most decision makers understand how problematic those projections are. And that's why most congressional leaders who I've read and quoted and seen on TV, and most others most others who are thinking deeply about this, are saying this is not the end. Congress is going to have to show up again, and the Fed is probably going to have to expand what they're doing. And so this is something where projections can be made, but I think that the responses need to also happen in real time. I mean, the CARES Act came out, and the $390 billion that was provided for the Paycheck Protection program was gone in a matter of days. So they passed another bill, and they funded another $390 billion. And if that's gone in a few days, I suspect they'll pass a third bill. I mean, a third round of PPP financing. It would be a 5th bill, I guess, a 5th form of support. So I mean, that's my best thinking on this. I think projections can be made. I think projections have been made, but nobody really knows. This is going to be an ongoing effort. question, and here's a question I don't know the answer to. Can you get a PPP loan and the expanded unemployment benefits for the self-employed? And honestly, I don't know the question to that. But I will tell you that our staff are researching it even as I speak. And before the end of this webinar, I expect Yusuf to be sending me the answer. So we'll come back to that one. So now let's talk a little bit about that point I made earlier, that the federal government is not like a household. It's a very popular analogy to say that households have to balance their budget. Households have to make sure they're not spending more than they're earning, and the federal government should keep its house in order too. Well, maybe it should, but the point is, it doesn't have to. There is absolutely no mechanical reason that the government cannot act sort of in any way it wants. I mean, there are some constraints that we'll talk about, but at the end of the day, the government can, you know, as the phrase goes, the government can print money, excuse me. And that can go on pretty much infinitely. And I'm not saying there aren't some boundaries on that. We'll talk about what some of those boundaries might look like, but in theory and in principle, the government can borrow infinitely, it can run infinite deficits. It can go on and on and on. And of course, a lot of people think about the Greek debt crisis from a few years ago. I think it started in 2012. Well, that's an example of a country that does not control its own currency. Greece cannot print money. Greece is part of a much larger monetary system based on the euro. And so they do not control their own currency. And so Greece is more like a state. Greece is more like California or New York or Colorado. They cannot run deficits. They have to borrow. And there's a limit to how much they can borrow. This is the problem with in the case of Greece, is that the cost of borrowing for them became astronomical. Whereas in the United States, you know, frankly, the Fed can buy all the bonds the Treasury can issue. And that's another thing. Again, we'll talk about that more in a minute. But this is something that's important to understand, is that the federal government has enormous scope of action, enormous leeway, and they're using it. And this is one of the things I find tremendously impressive, is that both parties are leaning in. Both political parties are leaning in and saying, we're going to do what's required. And so you've got, you know, we're about to have, well, I'll talk about deficits in a moment, but let me first talk about printing money, since we're talking about printing money. I'm sure that for some people, when someone talks about the government printing money, there's some image like this running through their head. And this is certainly the Bureau of Engraving and Printing certainly does print money. It prints Federal Reserve notes and provides them to the Federal Reserve for distribution throughout the banking system. But this is not what we mean by printing money. Interesting, I did see an estimate by the Federal Reserve that it estimates that there's $1 trillion of cash, of Federal Reserve notes, in circulation worldwide. Cash is a very popular form of asset, especially in other parts of the world. A lot of people hold cash as an asset directly. They don't care whether it's in a bank earning interest. So $1 trillion outstanding. But this is not what I mean by printing money. This is how the government prints money. This is how the Fed prints money, with a keystroke. If the Fed wants to print money, it just somebody sits down at their terminal, and they with a few keystrokes they add money to the banking reserves, and voila, there's more money. And when the Fed buys bonds, it pays for them by just adding to the bank reserves, keystroke. So it creates money electronically, and it creates money electronically because it could basically with a few strokes of the keypad, it can add money electronically to the reserves of any bank. And so that's why I was saying earlier, the current quantitative easing is not about driving up bond prices and therefore keeping long-term interest rates low. It's just one more mechanism for getting money into the banking system. And the banking system, at least when it's operating, when the banks are lending and people are borrowing, individuals and businesses are borrowing, it has a huge multiplicative effect. We operate in what's known as a fractional reserve banking system. This means that for every dollar a bank lends, it doesn't have to have a dollar in reserves. For every dollar a bank lends, it only has to have about 3 cents in reserves. Or maybe make the numbers a little rounder. For every $100 a bank lends, it only has to have $3 in reserves. And so let's say that the bank lends $100, it has $3 in reserves, but the thing about that is, how does the bank make a loan? It credits the borrower's bank account. And on average, a lot of that money sits there. So the minute it credits that borrower's bank account, that's another $100 of reserves. And so that can now lend another $97. And when that money is credited to a bank account, then that actually represents more reserves. And so these reserves magically appear. Every time a loan is made, more reserves appear, and they're all supported by this tiny little fraction. But it repeats itself again and again, so you get this exponential growth, or at least you get this potential exponential growth in liquidity from a very small injection of reserves. So let's go back to the Fed's balance sheet. The Fed's balance sheet, I said it's been buying massively. It's increased its buying of bonds and similar securities in the recent past, in the last few weeks. Here's a chart of the Fed's the last 12 years or so of the Fed's balance sheet, and you can see down here what, if you took that, if you just looked at that section of the chart, that would look like a massive increase, and it was at the time. That was the increase in the Fed's balance sheet during the Great Recession, when it went out and bought massive amounts of mortgage-backed securities and other, as well as some agency debt and other debt, and so that ended up on its balance sheet. And then you can see that the balance sheet grew again during the period that Ben Bernanke was still leading the Fed, and they engaged in quantitative easing. And again, this is when they were trying to keep longer-term interest rates down, and so they were out in the bond market buying bonds like crazy, and well, they were buying bonds very systematically. They had a regular program. They were buying X billions of dollars of bonds every month like clockwork, and that's why you see that line is rising very steadily and very, very consistently. And then eventually it leveled out. Eventually quantitative easing came to an end. And you could see, if you look closely, you can see a very gradual decline in the line. And that was because for a while after quantitative easing, they would still roll over the bonds. If a bond matured, they'd put it into a new bond. They'd invest it in a new bond. And then they stopped doing that. So when a bond matured, they would not reinvest the proceeds. And so that began to very, very gradually shrink the balance sheet. And then under Chairman Powell, they began actively shrinking the balance sheet, actively selling bonds. And they got down, and you see where it begins to decline quite notably. And during that period, they got the balance sheet down to about $4 trillion. And this is what we've seen literally in a matter of weeks or a couple of months. And you can see this is the biggest spike we've ever seen. And this just shows you the scale at which the Fed is operating in terms of its open market operations, in terms of its quantitative easing. It's out there buying bonds and similar securities like crazy. And as a consequence, that big spike represents reserves going into the banking system as well. That's the other way to think about it. Now, there's an interesting little thing about that. We talk about printing money, and of course, printing money is when the Fed adds reserves to the banking system by buying bonds, including buying treasury bonds, and we talk about running deficits. Well, what really happens here? That, by the way, that building on the left is the Treasury building in Washington, D.C. And for those of you who are musical fans, that is Alexander Hamilton standing in front of the building, or standing in front of the South Plaza. So when the Treasury finances deficit spending, it has to issue bonds. And so to the degree the Federal Reserve, that is the Federal Reserve building on the right, to the degree the Federal Reserve buys those bonds and adds it to its balance sheet, it means that the Treasury is paying interest to the Federal Reserve. But there's an interesting little thing that a lot of people don't know, and that is after expenses, the Fed remits all of its net income, which it gets from a variety of sources, including interest on the balance sheet. It remits its net income to the Treasury. So to some degree, the Treasury issues bonds. If the Fed buys those bonds, it turns around and remits much of the interest back to the Treasury, which may sound like a scam, but it's just the way the system works. You can see here, this is the annual remittances that the Treasury receives from the Fed each year. In 2015 was kind of a peak year. There were two different sources. There was about $100 billion that was interest income, and then there was another transfer from some reserves that the Fed had, and I think it added up to about $117 billion. And then it was declining, and part of the reason it was declining for a variety of reasons. One of them was that the Fed was starting to shrink its balance sheet. So you can imagine that the Fed having massively increased its balance sheet, including with huge purchases of U.S. Treasuries, these numbers are going to go right back up again. I mean, clearly in the next few years, it'll be back above $100 billion a year that the Fed is remitting back to the Treasury. So, and I don't know if I mentioned it elsewhere, so I meant to mention it now. I think the current estimate of this year's deficit is around $3.8 trillion, and the Fed is to date has purchased $1.6 trillion of Treasury securities. So just year to date, the Fed has, in a sense, financed 40% of that deficit. And you know the Fed's not done, so there's that. And that's another reason why interest rates and inflation are maybe less of an issue for at least for the foreseeable future. A little bit of inflation is a good thing. This is the thing that is important to remember. You often hear that the Federal Reserve has an interest rate target. Pardon me, an inflation target. The Fed has said for many, many years that they would like to see an inflation rate of about 2%. And I'm sure it's easy to think, well, wait a minute, isn't inflation always evil? Why would the Fed want to have a 2% inflation rate? Why would the Fed want to have any inflation rate? Well, the reason for that is that it's kind of a lubricant. It gives individuals and businesses an incentive to spend and invest. The thing the Fed and monetary authorities all over the world fear greatly is the opposite of inflation, deflation. That's when prices are not only not rising, they're actually falling. So that automobile you want to buy today that costs $30,000, if you wait a year, it only costs you $28,000. And if you wait another year, it only costs you $27,000 and so forth. The reason that central bankers are dreadfully afraid of deflation is that it causes a decline in economic activity. All of a sudden, it removes all the incentive for consumers to consume and for businesses to invest. You know, if as a consumer, I know that if I'm waiting a year, I can get that refrigerator for 5% less, or I can get that car for 5% less, or whatever, I'm disinclined to spend the money today. And if I'm a business and I know that I can build that plant for 5% less, if I just delay for a year, I might delay that investment. The problem is that creates a vicious cycle in which if everyone is putting off a major purchase, then companies start laying off employees because the demand for their products is not as robust as it could be. And the more that employees get laid off, the less aggregate demand you have. And so companies lay off more employees and it goes down and down and down. So a little bit of inflation is actually a healthy thing. It creates all the right incentives. A lot of inflation is not healthy. It creates all kinds of unintended consequences. You know, people start making financial and economic decisions based on inflation rather than based on fundamental economic principles. So there's a balancing act. There's a sweet spot, and the Fed believes the sweet spot's about 2%, and they have struggled mightily to get to that 2% inflation rate over the last 20 years, and they have rarely gotten there. and we're back below 2% again. Perhaps not surprisingly because of the economic slowdown. Part of the reason the Fed and other central banks have struggled so much to actually get some inflation when they wanted some is due to globalization. Historically, when the global economy was much more compartmentalized, you could get these pinch points within a country or a region that could cause inflationary spikes, where there was a shortage of some raw material, and the scarcity as a consequence caused the price to skyrocket. Because when you have too many dollars chasing too few goods, the prices tend to go up, and that's called inflation. Also, you could get a pinch point where the unemployment rate got really low. Prior to this pandemic, our unemployment rate was at historically low levels. It was barely above 3%. And when I was studying economics in graduate school, I don't know, 30 some odd years ago, a long time ago. Yeah, I won't even say how long ago. There was a belief then that the received wisdom, the best theory, was that if you got below about 5% unemployment, it was going to start to be inflationary. And the reason was that there's a certain natural unemployment rate, sort of a frictional unemployment rate. People are always in motion, but going from one job to another, you're always going to have 1% or 1.5% unemployment, just because people are moving around, not for any really structural reason. And then above that, if the unemployment rate gets below 5% or 4%, this is the old theory, it was considered inflationary because employers would start competing with each other for scarce employees, and they start bidding up salaries. And so wage inflation was one of the biggest causes of inflation historically. Well, one of the things you noticed, I assume, is that wages have been pretty stagnant. Although they began to rise a little bit in recent years, they didn't rise dramatically, and they certainly didn't rise dramatically as the unemployment rate neared 3%. So this was, economists the world over, including myself, had to start throwing our old verities out the window. Well, part of that was due to globalization, because we have now what are known as global supply chains, where parts can be built and final products assembled essentially anywhere in the world. And there's a system of transport and finance and logistics in place that allows companies to very rapidly move things around. And so if labor gets too expensive in China, which it was getting too expensive, they just moved their manufacturing to Vietnam. And we've seen a lot of that. A lot of manufacturing has moved. A lot of manufacturing where labor was a significant input has moved from China to Vietnam. And so this stuff just moves wherever it needs to move, and it means that workers have less leverage than they used to. There's also a global savings glut. What does that mean? I mean, historically, the theory of savings is that it allows intermediation. It allows temporal intermediation. It allows individuals who have more income than they want to spend to set it aside and make it available to those who have more spending needs than they have income. So some people can be lenders and some people can be borrowers. Well, right now, there are more lenders than borrowers. There's more savings available worldwide than there are borrowing demands. Companies are not investing as much. Companies are internally building up cash, and individuals reaching the retirement age are primarily savers. And so you've got this savings glut, which means that you've got a lot of dollars chasing savings opportunities, and you have too few investments. And so what does that do? That drives down interest rates. And when interest rates are being kept really low as a consequence of the savings glut, that also keeps inflation low. Now, right now, on top of everything else, and really, by orders of magnitude trumping everything else, is the fact that we have 26 million Americans unemployed and similar numbers worldwide. And when you have that much slack in the economy, it's going to be a long time before we have inflationary pressures. And so in fact, let me say I have a question. If 2% inflation is good, what is the impact when wages haven't kept up with inflation, as has happened for the past 30 years? Well, it's not. The impact is bad. The impact is bad. The impact is that each generation is potentially going to be worse off than the generation before. I read this statistic the other day, and I'm not going to produce it correctly, but 50 years ago, after World War II, the next generation that came along and entered the workplace could assume that they were going to earn 8 times as much as their parents earned. And similar numbers we're seeing generation after generation after the middle of the last century. That's not been the case. And it's been to a significant degree, because of stagnant wages. Now, we have had a small segment of the population, of the workforce, that has participated in the information economy, if you will, and they've done very well. And so, we also have this enormous disparity of income, where the top 5% of wage earners are earning as much as the next 95% combined, and that kind of disequity, that kind of imbalance, it makes for a lot of social problems, and social problems turn into economic problems. 40 years ago, the CEO of a publicly traded company earned a salary that was about 40 times what his or her secretary earned. Let's be honest, 40 years ago it was probably a him. 40 years ago, the CEO earned about 40 times what the CEO's secretary earned. Today, it's about 4,000 times. And that's something that people have been writing about, people have been thinking about, and that's one of the excuses for a little bit of redistribution within the economy. It's you don't want to redistribution. Economists are all about incentives. That's a lot of what economists think about, is how can you create different kinds of incentives? Everything aggregates up from the individual. When you talk about how Congress and the Federal Reserve have these levers they can use to change the macroeconomy, to make changes to the rate of economic growth, or to make changes to the rate of inflation, those levers aren't working directly on the macroeconomy. Those levers are changing the incentives for individuals. Those levers are changed. For example, if the Fed lowers interest rates, well, that encourages individuals to go out and buy more products and borrow more money. And then that aggregates up to faster economic growth. It's not that the economy grew faster because of the interest rate per se, it's because individuals were incented to behave differently, and those individual behaviors aggregated up to a change in the macroeconomy. FYI, 30 million unemployed as of this morning, 4 million new claims today. Thank you. I didn't get a chance to see today's numbers. Also, are you still expecting a V-shaped recovery? So I want to be clear. I think I was a little too nuanced in my last webinar. I'm not predicting a V-shaped recovery. One of the things that I wanted to emphasize last time, and one of the things I'll emphasize again, is that a V-shaped recovery is not out of the range of possibility. One of the things that I've gotten a little tired of in terms of seeing how this is covered, even in the news publications that I really respect. My go-to newspaper is the New York Times, and honestly, I've been a little annoyed recently when it started to feel like the New York Times is catastrophizing every aspect of this pandemic. If there is a range of possibilities, if there are a range of scenarios, they will always report the worst scenario as the most likely scenario. And for that matter, some of our public officials are doing the same thing. Now, I understand that there's a desire to get people to be smart, to stay inside, to shelter in place, and all of that. I'm not sure we need to treat people like children and try and scare them into that. So I'm trying to create a little balance and say, the worst scenario might be the one we see, although I doubt it. The middle scenario, that U-shaped recovery, has a pretty significant probability associated with it, but there's also a not insignificant probability of that V-shaped recovery. If the U.S. government, through its various arms and efforts, can keep the pipes open, can keep all of those those companies that would otherwise would have been viable alive until the recovery comes. I saw a presentation by Ed Lazier a couple of weeks ago. He's a Stanford economist who was also chair of the president's of George W. Bush's Council of Economic Advisors, and he was talking about this current economic experience we're having as being, this supply side shock. That's something I talked about in the last webinar. This supply side shock we're experiencing. He said the closest thing I could compare it to is World War II. And it's interesting because I've been revisiting all the statistics in recent days as I finalized this presentation, and all of the numbers that we're seeing are of a magnitude last seen during World War II. Well, one of the things he pointed out is that when World War II ended, there was such an enormous pent-up demand that the economy exploded and took off like a rocket ship. I think that that's within the realm of possibility here. I don't want people to think that I'm predicting it, that I'm saying this will happen, but I think we need to bear in mind that it's a non-trivial possibility. So that was a long answer to the short question, but that's those of you who know me know that that's what I'm most known for. Okay, so I just got an answer to the earlier question about can you apply for both the payroll protection program and the enhanced state unemployment for self-employed, and the answer is no. While self-employed workers and anyone who gets paid via a 1099 are eligible for both, you can't double dip. So if you get PPP, you have to withdraw from unemployment. So this is something though to kind of keep in your back pocket. If you apply for a PPP loan and fail to get it, apply for unemployment. You'll have that as a fallback position. I think you'll have more. Well, it depends on your company structure. Where you'll have more money available, and you should consult with us if you're in doubt, and we'll try and help you choose between which program you should pursue first. So now I want to say one more thing about inflation. What are the markets telling us? Because markets contain a lot of information. The stock market and the bond market are both made up of investors. And those investors are all showing up every day with their non-overlapping bits of information and voting with their dollars. And the prices in those markets, whether it's a bond price or a stock price, eventually become what I call information dense. The prices get pushed up and down until some equilibrium is arrived at. And that equilibrium may or may not be right. New information may roll along that causes that equilibrium price to change. But at any given moment, that equilibrium price represents the balance of the best judgment of all of the millions of players who have money on the line. So bond markets give us information about interest rates and inflation rates also. So there's a thing called, so first of all, the bond market, you can look at bond prices, and they will tell you implicitly what the bond market believes forward rates are going to be, which is say rates in the future. And the bond market is currently predicting that over the next 5 to 10 years, the Fed funds rate is probably going to be about 1%. That's just a piece of market information. The markets are predicting that for a long time to come, the Fed funds rate is going to be quite low. And then there's a thing called TIPS. So the TIPS is an acronym. It stands for Treasury Inflation Protected Securities. And it's a treasury bond that is inflation adjusted. Now, the way this works is that the treasury bond pays a yield. It has an interest rate that it pays, and it doesn't change the interest rate it's paying with changes in inflation. But when the inflation rate changes, when there's inflation, what the treasury does is it adds that onto the value of the bond. So if you have 2% inflation, then in a given year, then the bond value goes up by 2%. But TIPS give you information about expected inflation rates. And what the TIPS are telling us right now is that there's an expectation over the next 5 to 10 years that inflation is going to be about 1.5%. So, so for what it's worth, markets are suggesting that interest rates and inflation rates are going to be low for quite some time to come. All right, so this is the point. I was going to move on to questions. Obviously, we started getting questions sooner than this, but I welcome any more questions that you may have. I hope I hope what I've covered over the course of the last, oh gosh, I went for over an hour, that I've covered over the last hour plus. I hope it made sense. I hope it was useful. You definitely want to reach out to us and call us or email us if there's anything that didn't make sense, or if you have any questions or comments beyond that. We always are very want to hear from you. And the one thing I wanted to, I still have questions coming in, so stand by. But I wanted to draw your attention to something else. Last week, we sent you all a link to a video called The Phoenix, which was produced in Ireland by a group called The 10th Man. This is just an amazing production. It's moving. It is poetic. It is all about how we're going to come through this. I'm getting emotional thinking about it. Okay, I'm gonna tell you the truth. I've watched this more than once. I cry every time. And in fact, if you haven't watched it, you go watch it. And we'll send you another link if you can't find our last email. And when you next talk to me, don't lie to me. I know you cried. So I'll leave you on that thought. This is a please, if you haven't watched it, go watch it. It's only a few minutes out of your day, and it'll make your heart happy. With that brings us to the end of our webinar. Thank you very much for joining us. And this is being recorded, so if you want to watch it again, which I can't imagine, but if you want to share it with friends or colleagues, please do so. We'll be sending you the link a little later today, and I look forward to seeing you the next time.